Okay, so now we're going to walk through a rather lengthy finance lease example problem. Again, this is somewhat of a long lecture, longer than most of them have been. I apologize for that, but there's just a lot to go through. And so hopefully you can bear with me and you'll learn a lot from this lecture. Okay, so first of all, we have some information about a lease. In practice, of course, you'd have some sort of contract and maybe some email traffic or letters or something like that, and you sort of have to go through all of that information and figure out exactly what you have in terms of the lease. Now, in this case, we just present the information in a somewhat straightforward format. First of all, you can see that the lease is signed on October 1st. There are annual payments, and the payments are at the end of each annual period. We have the fair value of the trucks at the time the lease is signed. We have an estimated residual value. There is a partial guarantee on the residual value, and then just some other things going on there as well. So basically, we're going to take this information and we're going to provide the journal entries for 2020, 2021, and then 2025. First of all, we have to walk through the 5 criteria. There are 5 guidelines that we talk about. So there's the transfer of ownership, the purchase option, the lease life, present value, and alternative use tests. There is no, in this particular lease, there's no transfer of ownership or purchase option. In this case, we do see that the lease life is more than 75% of the remaining useful life of the asset. So at a minimum, that would be one criteria with which you probably should treat this as a finance lease right off the bat. We're also going to evaluate the present value to see what that tells us. And in this case, there is also an alternative use at the end of the lease, and so that doesn't trigger anything. And so really we're down to the third test, the lease life and the present value test. And so this will be a finance lease based on the lease life, but we're still going to walk through the present value calculation. And so first of all, I would say, as I mentioned in an earlier lecture, we do need to start by calculating the implicit rate in the lease. It is a 5-year lease. Currently, the market value of the asset, the right of use asset, is $350,000. Each payment is $85,000, and the estimated residual value of the asset from the lessor's perspective is $50,000. And so now we have enough information to calculate the implicit rate. In this case, that implicit rate is 10.34%. The next step is to then use that information to calculate the present value of the minimum lease payments. The N and the I/Y are the same, 5 years, 10.34% as a discount rate. Notice again, I switched the payment to a negative because from the lessee's perspective, they are making the payment. And I also changed the FV, the future value, or that residual value, because the lessee has only guaranteed $15,000. And so that's why instead of $50,000, it's only $15,000 as that FV. And so the present value is $328,601. And that is more than 90% of the fair value of the right of use asset. So in this case, both the lease life test and the present value test suggest that this is a finance lease. And so we're going to treat it as a finance lease. The first thing we're going to do then is we're going to amortize the lease liability. We have the carrying value of the lease liability when the lease is signed on October 1st, 2020. And so from there, we amortize that liability. And so the interest expense is calculated as the implicit rate times the previous carrying value. And so in this first line on 9/30/2021, we take the carrying value of $328,601 and we multiply it by 10.34%. That gives us an interest expense of $33,980. The amortization is the difference between the payment and the interest expense, and that amortization goes as a reduction towards the carrying value of the liability. And so what we have is we have that carrying value going down, and it's going to go down from that present value, $328,601, all the way down to that future value of $15,000 through the amortization process. And so we repeat that every single year. And so our final table then is complete. through that amortization, and you can see that over time, as the carrying value is reduced, the interest expense is reduced, and the amortization increases until we arrive at the $15,000 residual value at the end of the amortization table. And barring any rounding errors, that's exactly where you'll end up every time. You'll always end up at the residual value. So the next step is to record or calculate the amortization of the right of use asset. So the amortization expense is much like straight line depreciation for property, plant, and equipment. The framework is very similar. You start with the present value, you subtract the residual value, and you divide that by the lease life. And so for this example, the present value is $328,601. The residual value is $15,000, and the lease life is 5 years. And so the amortization expense for this asset, this right of use asset, is going to be $62,720. And so that initial journal entry, we recorded on October 1st, 2020. We debit the right of use asset, in this case it's a piece of equipment, and we credit the lease liability for the present value of the minimum lease payments. The next journal entries that we'll have to consider are any adjusting entries at the fiscal year end, and there are two. The first one is going to talk about accruing interest as an adjusting entry. And so basically what we see is the fiscal year end, the 12/31/2020 fiscal year end, lies between October 1st, 2020 and September 30th, 2021. And so we're at the second line of our amortization table. And so now when we calculate our accrued interest, we use that basis of $33,980 from that second line. And of course, we accrue 3/12 in 2020 for a total of $8,495. So we record our interest expense, and then we accrue that interest expense to the lease liability. And so we actually increase the lease liability account balance. The second adjusting entry is the amortization of the right of use asset. In this case, we do not own the asset, or sorry, we're not leasing the asset for the entire year, and so we need to prorate the amortization. So we take the annual amount, $62,720, and we multiply it by 3/12. And so the amortization for 2020 is $15,680. So as a sort of a extra step in this problem, what we're going to do is we're going to walk through the financial statements that we would report in 2020. There are three balance sheet items that we need to think about. First is the balance for the right of use asset, and then we're going to have a current portion of the lease liability and a non-current portion of the lease liability. So those three items would be reported on the balance sheet. So for the right of use asset, it's pretty straightforward. You take the initial carrying value and you subtract any cumulative amortization. In this case, there's only been 1 year, and so actually only a partial year of amortization. And so the account balance for the right of use asset is $312,921. The current portion of the lease liability is actually quite complicated, and so you may need to kind of look over this several times, but it is a pretty dense calculation, so just try to pay attention. So I'm going to give you the account balance. This is what would be reported on the 2020 balance sheet. Now let me walk you through how we get to that account balance. So the current portion of the lease liability is the 12/31/2020 account balance minus the 12/31/2021 account balance. Essentially, we're capturing the amortization that will occur in 2021, and that is the current portion of the lease liability. So we're going to start with the 12/31/2020 account balance. And so we take the original account balance on 10/1/2020, and we add the amount that we accrued to the lease liability as far as our adjusting entry on 12/31/2020. And so the total account balance on this date is $337,096. We very similarly calculate the 12/31/2021 account balance. So if we look at our amortization table, we have our 9/30/2021 account balance, and we need to add any accrued interest that would occur at the end of 2021, because we know at that adjusting entry, we add the accrued interest to the lease liability account balance. And so in this case, The interest expense that would be accrued at that time, at 12/31/2021, would be $7,176. We add that to the table amount for a balance of $284,757. And so the difference between those two is $52,339. And then the non-current portion is simply the 12/31/2021 account balance, which we just calculated on the previous slide. On the income statement, we report both the interest expense and the amortization expense, just as we got from our journal entries, so hopefully that one's not too difficult. All right, so now we're moving on into 2021, and the first thing we're going to have is the lease payment on September 30th, 2021. And so first of all, we have the remaining interest expense, and so we have a total interest expense of $33,980. We had previously accrued $8,495, which means on this date we will record $25,485. The lease liability account is the amortization from the table, the $51,020, and we need to also amortize the amount that we accrued to the lease liability at the end of the previous fiscal year, that $8,495. And so the entry to the lease liability account would be a total of $59,515. And the cash, of course, is just the contractual payment of $85,000, and those all equal out. So now we move on. Now we have at the end of the fiscal year, at the end of 2021, we would have an adjusting entry, and now we need to move down in our amortization table because now we're sort of in that space between 9/30/2021 and 9/30/2022. And so now the relevant interest expense is $28,704. And so the accrued interest would be the $28,704 times the 3 months that occurred in 2021 for a total of $7,176. And just like we did last year, we accrue that to the lease liability account. Of course, we still have to amortize the right of use asset. And this year, of course, it's a full year, and so the amortization expense is a full $62,720. That's the amortization expense, and it also reduces the right of use asset account balance. So now we're going to fast forward to the end of the lease, 2025. And now we're at that final line. Of course, we would have had adjusting entries and payments throughout. And so it's important you consider the fact that there would have been adjusting entries on 12/31/2024. And at that date, we would have partially recorded the interest expense of $9,372 based on the 3 months in 2024. So that's just something to keep in mind as we record our journal entries for 2025. The first journal entry is to record that final payment. The interest expense, of course, is the remaining portion, the 9/12 that accrues in 2025. We also have to think about the amortization of that lease liability. And so similar to what we had done before, the entry to the lease liability account is going to be a function of both the amortization and any previously accrued interest against that account. And so the amortization is $75,628 taken from the last line in the amortization table. We also know that a portion of that interest expense, $9,372, would have accrued to the lease liability account at the previous fiscal year end. In fact, 3/12 of that would have. And so that gives us together the entry amount for the lease liability account. And so we have the table amount from amortization and, of course, the previously accrued interest for a total of $77,971. And the cash, of course, is the contractual payment. Since this is the end of the lease, we're not quite done. The first thing we have to do is we have to continue or finish amortizing the right of use asset. And so in this case, we have 9 remaining months in 2025. And so we need to record that amount as an entry as at the end of the lease. So there'd be a total of $47,040 of amortization at the end of the lease. And then finally, because there is a residual value to this asset and liability, we need to take both of them off the books for an amount of $15,000 debit to the liability and a $15,000 credit to the asset.